Hello again. This is Steve for Ask the Business Builder. Today we have talked about the profit and loss statement, and now we're going to show you some illustrations of what a balance sheet would be. Again, as a new business owner or someone trying to start or build a business and become more profitable with higher revenue, the demands on your financial statements for banking, accounting, even the IRS become far greater. We aren't going to go into an accrual versus cash basis and those kind of issues on these short videos. We will be going into that on our premium videos that we'll be producing at a later date and time. But regardless, we're going to show you a couple illustrations now of what a balance sheet looks like, and hopefully this will help you out. So here you go. Okay, well, welcome through that hopefully smooth transition that we just had. Welcome to the our illustrations here. Right now we're going to be talking about the balance sheet, and this is hard to explain somewhat in a lower section if you want to consider it vertically. On the top side you have assets, or things that are positive, and then on the bottom side you have liabilities and equity. And I'll explain why that is in a second. The end of the story, though, is that this and this number, when we get to the bottom line of each one, should equal. And that's how a banker or financial person understands that your banks are in balance. Your accounts are in balance. Your assets in a business would be close to the same as they are as home. That would be money in your accounts, like your savings or checking, so forth, stocks, bonds, any place where you have money that belongs to you. It could also involve equity in your home. It could involve accounts receivable, or dollars that are owed to you. Like I said, it also includes anything that you may have some value in. Could be a car. Let's say if you had a car that was paid for it. For instance, that car was worth, say, $7,000. So that dollars would be an asset for your car. Okay, jewelry collection, money collection, whatever. All those kinds of things add up. And in a business, that could be inventory. It could be your non-depreciated value of office furniture, things of that nature. But an asset, generally speaking, is something that is a positive. It is your worth. It is the business worth. How much money does the business have? Okay? Now your liabilities are obviously the exact opposite of that. So your liabilities would be your accounts payable, or dollars that you owe to somebody else. Whoops, sorry about that. My pen's not working real well all of a sudden. Anyway, that is dollars that you owe other people. That is a liability. In other words, dollars that you may have in the bank, but you're going to be paying out. And that could, in fact, be maybe it's past due, maybe it's taxes, maybe it's a property tax bill that should be on your profit and loss statement, but maybe it's past due and you hadn't paid it since last year. That would be an outstanding balance. Could be considered a liability. Anything that you owe for is in fact a liability. So then you got the magical thing over here called equity. And what we're doing with the equity side is we're taking the total amount of liabilities, money that you owe other people. Accounts payable could be accounts payable for product that you've received. There's a number of things that maybe you buy a lot of things on credit card and it's been paid for through your credit card, but the credit card bill comes in. Now that is a balance sheet item because it's an accounts payable outside of the product that you bought, because that was showed on a profit and loss statement. I know it gets confusing, bear with me here, but let's say this was your $100,000 up here to the positive. Then down here, perhaps that you could be $110,000 to the negative. However, the equity, which is right here, which is money that you have invested in the company, it's also current net profits off your profit and loss. So if you look at your profit and loss, your income statement, at the bottom line it showed that you have a $20,000 net profit, so for the month or for year to date. That, let's say that $20,000 then becomes equity, because it's money that you don't necessarily may not have, because it's in accounts receivable versus accounts payable and so forth. But still, at that, it's a $20,000 positive over here. When you deduct that $20,000, let's make it $10,000 so it makes sense. Now you have $100,000 negative. And this number here and this number here balances out. So that's exactly what it's supposed to do. Hope we didn't confuse you too bad with your balance sheet. But in summary, again, the balance sheet is vertically two components, assets and liabilities. Assets are money that you have, property that you own that has a value. Anything that you have that shows or can demonstrate to a financial institution or maybe to yourself that you in fact have a value, or you have money in the bank. Your liabilities, on the other hand, detract or subtract from the assets, in that it's money that you owe other people. It's a negative value. And then the equity that is on the liability side actually comes back out of the liabilities, because it's money that you have ingested, or you have invested in the company, or you've invested in yourself perhaps, or it's income that you have on your profit and loss statement that you haven't actually booked yet. Okay, so that's it. Again, it'll go into greater detail. We'll go into greater detail in our premium series, but I hope this helps. This is Steve again for Ask the Business Builder. Have a great day.